Okay, today I want to do a little bit of research here. I don't know what the answer is. We're going to basically document it and then publish it. We know TLT had this huge rally, and if I use my mouse, we went from around 140 to 143. We had this historic spike up. And we know even on this Friday that the short dated calls were up 3,000% on March 6th, of Friday. We shot a video on that. And then, of course, the following day, we went up and made a high at almost 180. Huge surge in volatility, millions of dollars made. I'm guessing millions of dollars lost if people were shorting this. And because of this huge move, we had a huge explosion in volatility, which meant all the calls and the puts went up as well because of volatility. And just to repeat myself as I have in every video, the price of the option is defined by three things. One is time, how long before it expires. Second is what the stock price does relative to the strike price of your option. And the third one, which is equally important, if not more important, what happens to volatility? So when we had this big breakout move, we had volatility surge in the options. Now the question I'm asking, and we're going to find out today, when we move from down here to here, the calls went up 50-fold. So I've easily made a fortune from here to here. The question is if we bought a put here with vols elevated, if the vols are elevated when we're up at this level, if we rally from here to here on a point move and make 50 times on our calls with elevated vols, what happens when we move from here back down to here? So 3 days ago, the TLT plunged even below 140. Would we have made 50 times on our puts? I'm going to say no. I'm going to say that because vols were elevated and we would have been buying our puts up here, and this is obviously assuming we picked the market perfectly, my theory is that the return on those puts would be significantly less because of the elevated vols. But would it have been worthwhile doing? Would we have made money? How much money would we have made in the perfect scenario? And it'll be interesting to see. We probably want to do it over the same time frame. So we're probably looking at 1, 2, 3, 4, 5, 6, 7. It took 8 days from the high to the low. And it'll be interesting to see what happens with volatility from there. And then what we'll probably want to do is to measure 8 days back. So really 1, 2, 3, 4, 5, 6, 7, 8. So we'll probably want to go back to February 27th, see what the calls were worth there, use this as our time frame, see what happens to our calls here when they go up 50 times, and then see what happens to the puts when we go all the way down here. And my guess, maybe 10 times, but not 50 times. And that's because of the elevated volatility in the marketplace. Here volatility was low, and here volatility was high. I'm going to say volatility contributed more to the value of the option than this huge move in price, which would be hard to believe, but that's my guess. And then my guess is from here to here, vols came down, and that negatively impacted the value of the puts. But the question I have in my mind is, when we move all the way from here down to here, how much would those puts be worth? And so that's what we're going to do next. We're going to take a look at the calls, and then we're going to take a look at the puts. And we're going to see just how big an impact this volatility had. And obviously, I'm assuming, of course, that volatility came down. But given the size of this move from here to here, that's another question I have. Should we expect volatilities to decline even though there's a big move down? I'm going to say yes, but let's find out. Okay, we're going to do a quick analysis on TLT. What we're doing is we're looking at February 26th today. We're going to look at the calls, how much we pay for the calls, And then how much do the calls go up between now and the high on March 9th? Then what I want to do is I want us to buy puts on March 9th when TLT goes to 180. And then 8 days later it's going to plunge to on March 18th to 140. I want to see how much money can we make on the puts versus how much money we made on the calls on the way up. And I want to see how much volatility basically eats away at our returns, because when we buy these puts at the high, volatility has gone through the roof. And then when we get down to March 18th, vols are going to probably come off a little bit. And then I want to see how much money do we make, which is going to give us an idea about how volatility impacts returns. So if we look here at the 150, we're going to be looking at the 150 calls trading right around 4, and the puts right around 370. The out of the money puts are going to be trading around 60 cents. And you know, I think what we'll do is when the market plunges after making new highs, it'll be interesting to see what happens to these puts, because we end up dropping back down to 140. Be interesting to see how much those go up by. And then so we're going to keep track of 150 calls, and then out of the money, the 160 calls are trading for around $1. So these 160 calls, okay, when we hit 80, they got to be worth at least 20 bucks, right? That's the intrinsic value on them. So let's go jump ahead now to March 9th. Oh, and just before we jump, let's just take a quick look here. The 160 calls, what's the implied volatility? Okay, this is a good point to look at. We were looking at 18% for out of the money, and we were looking at 17% for in the money. So we were basically 15 to 17%. 160s are 18. All right, so let's just give it a benefit of the doubt. We're going to say implied vols are 18% across both the calls and the puts. It's a little bit lower than that. And now let's jump ahead. Now here's TLT half an hour into trading on March 9th. The option market struggled to open that morning. It took almost half an hour for this thing to open up. So what did we find out? Well, what we found out here is that 140 put that that was trading for 60 cents, guess what? Traded 75 cents. So 8 days later, the 140 put is 75 cents. It's actually gone up. And the 150 put is trading between 151 and 175, and that was trading at 370. So the put's gone down to, let's just call it $2. So that one's dropped, but not even half. So it's dropped from 370 to 2. And now the 150 call that was $4 is now trading at what? Hit $30, and it's probably like 28 or something, but 50 contracts traded at 30. Well, let's just put 30, keep it simple. So the $4 call went to $30. So that's up 7.5 times. And then the 160 call traded 22, traded 20. Let's just call it 20 now. It was trading a little bit higher. Let's call it 20. So the 160 call went from $1 to $20. So that's up 20 times. Okay, so we're looking 20 time returns on the call, and the puts hardly went down at all. The at the money puts went down by almost half. So huge return. Now what we want to do at this point, obviously everyone was looking at the market going higher, not lower. Well, I think this tells us something already. The puts from 8 days ago really haven't dropped. So what happens here on March 9th? We're now going to take a reset here. We're now going to look at the at the money puts. And we'll just do it from, the high was 180. We'll just use the 180 put. Or let's use the 175 put, because we're at 176 now. And so let's just say with TLT at 176, we're going to look at a put, at the money put, is basically trading $12. And an out of the money put, which would be $10 away, is trading at around, traded down to 4, but let's just say this is trading around, it just traded $6.95. Let's call it $6. I know there wasn't a lot of liquidity that day. It was going to be really hard to get anything done. And then at 176, if we just want to measure what the calls are doing, the 175 calls are trading high of 13. Let's just call it 11. We'll say the at the money calls are trading at 11, and then the out of the money calls, which would be 185. Let's just call that $8. $10 out of the money. So remember, the $10 out of the money calls back on February 26 are trading for $1. $10 out of the money call, which is even less than 90 days, is now trading around $8. So you can see how much we're paying. So now we're going to go to March 18th, and let's see what happens when the TLT crashes from 176 down to 140. What happens to those puts? The out of the money calls made a 20-time return. Let's see what happens to those out of the money puts. Okay, now we've jumped back to March 18th. The TLT is just broken below 140. It's 2:45 in the afternoon. And look at the TLT. It's plunging down, and this is going to be the low right here. And look and see what has happened to our options. So what we're trying to prove here is that when vols are elevated, your return on investment is significantly less than in a low vol environment if you get a similar move. So when originally on February 26, we had bought out of the money puts on TLT for 60 cents in a low vol environment on February 26. We're 3 weeks later. We paid 60 cents for them, and they're now trading at over $10. This is after TLT went up to 180 and came back down. So we still ended up making a huge return because, again, the market vols exploded. But to be fair, we're at 140 now versus 150 on February 26. Those at the money puts at the time, we bought those for 370, and they're trading at 17. So we're making about 5 times on those versus 15 times on the puts. Now, at the high on March 9th, what we did is we bought a 175 put. That was 8 days earlier in a high vol environment. And those 175 puts that were at the money, we paid $12 for those, and they're now trading at 40. So we got 3 times return on our money in a high vol environment, which is interesting because at 180, we bought a 175 put. 8 days later, it was up 3 times. But 8 days previous to that, we had bought a 140 put. Okay, 35 points lower, 2 weeks earlier, and we only paid 60 cents for that, and it's now trading at 10. So we're up 15 times on a 140 put that we purchased 2 weeks earlier. So we had 2 weeks of time decay on that, and we were up 15 times versus only 8 days later, a 175 put, and we're only making 3 times. Now the difference there is that we had to buy the 175 put in extremely high volatility, and that's what's really killed our returns. Now to be fair, for likes, we need to look at the 165 put, which was out of the money 8 days earlier, and that one we bought for 6, and it's now trading around 28. So that one, again, is still less than 5 times. So 5 times return on an out-of-the-money put at the 165 versus 15 times on a 140 put that was bought 2 weeks earlier. So there you go. That really shows the impact of volatility. Can we make money? We can still make money, but the return is going to be 3 times to 5 times versus 15 times.